Do you remember when the housing market was absolutely insane?
Now to the red-hot housing market.
The hottest month in housing history. Median sales price more than $350,000.
Mortgage rates dropped in 2019 and will likely stay low through 2020.
Adding to the biggest yearly increase in housing prices in 15 years. Selling fast, 17 days on average.
It wasn't too long ago when you had open house lines out the door.
We just simply don't have enough homes.
People putting in 9 offers, still losing, or
Nearly 100 home visits and 9 failed offers later.
people even putting in offers $20,000, $50,000 over ask
$20,000 to $50,000 on average over list
Going
price.
over, yeah.
and still losing out.
Life's not fair, is it?
Well, here we are in March 2023, and all that seems to be gone.
Party is over.
Look at this roller coaster over the last several months. Rates went over 7. Mortgage applications from home buyers dropped dramatically.
It's a completely different vibe. So, what happened?
During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why.
Inflation sent food prices soaring, surging nearly 10 cents from a week ago and 40 cents from last month.
Increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation.
That new number on inflation, worse than expected. And
$1.79 for a dozen eggs, now it's $4.25.
in an effort to bring inflation under control, the Federal Reserve is raising interest rates.
Breaking news on the economy. At any moment now, the Federal Reserve is expected to raise interest rates for the 6th time this year.
The Fed's goal to tamp down inflation, which is
Well, a lot has happened. Today, we dive into the current state of the real estate market and mortgage rates, as we have seen mortgage rates increase very rapidly over the last 4 weeks.
Rates have moved 100 basis points higher since the start of February.
Many people aren't even aware of this because it has happened so quickly. Heading into the spring market, which is the buying period at the beginning of the year, that kind of sets the whole tone for the rest of the year. This year's spring market is a lot more calm, but with everything happening right now, there's still one piece that's missing that can be very detrimental to the country and the economy and the housing market. But first, we have to talk about mortgage rates.
Rising fears that inflation is not getting in check is pushing bond yields higher, as you all know.
And in case you don't know who I am, my name is Joe Majorana. I am a realtor here in Boston, which is now the 2nd most expensive market in the nation, right after New York City. Which is why you should hit the subscribe button and the like button to please the algorithm gods on YouTube. Last year, we saw mortgage rates go up pretty much all of 2022. They started from just below 4% and increased past 7%. In the winter, they calmed down to 5.99%. This created some much needed optimism as we were approaching the spring market. Maybe interest rates were stabilizing, or maybe they were actually trending down. However, in the last 4 weeks, interest rates increased very rapidly to where they are currently when this video was recorded. Okay, big deal. What does this mean? 1 year ago, interest rates were at 3.96%. Well, let's say you're in the market to buy a home for $500,000. I know for a lot of people that does seem like a lot, but here in Boston, you don't really find too many opportunities under $500,000. With 20% down, $100,000, you would need a loan of $400,000. Before taxes, insurance, HOAs, etc., this would mean that your payments would be $1,887. Today, just 1 year later, with interest rates at 7.18%, your payments have increased to $2,668. That's a 40% increase.
Wow.
In fact, if you wanted to keep your payments to $1,887, the highest loan that you could take out is $250,000. Or you would have to revise your budget to be only $350,000.
What the? Why are you talking like that?
And let me tell you something. You can't really get too much in Boston for $350,000. Well, actually, you might be able to get a parking space in the Back Bay. But one thing to note is that for every percent increase of the mortgage rates, the purchasing power of a buyer goes down 10%. So now you have interest rates going up, causing buyers to pause their search. And now it's been reported that mortgage applications filed are at the lowest levels in 28 years.
What? Hear your pain.
Guys, this is even lower than after the 2008 financial crisis. So why is this important? It's because it is a strong indicator of the future of buyers. Less buyers are applying for mortgages, which means less people are out, which means less buyers are out hunting for homes, which means less demand for homes, less transactions. And right now we're already seeing less transactions compared to last year. And depending on which region you live in, inventory has been increasing pretty quickly, and there are price decreases happening. But the million-dollar question is, will the housing market finally crash? Well, in my opinion, which are of my own and not my team, I don't think we see a crash quite like 2008. There are a couple reasons for this. Number one, mortgage requirements have gotten a lot more strict since the 2008 financial crisis. It just takes a lot more to qualify for a mortgage now. You have to be more financially stable. Second reason is that many people have bought homes with fixed rate as opposed to adjustable rate. So these increases don't really change their payments at all. Not nearly as many people are going to be underwater because of this. And then the final reason is because inventory. Yes, I did say that inventory is increasing in a lot of parts of the country, but overall inventory is still pretty low. Now I know that every region, every city, and even the neighborhoods within a city can be telling different stories about inventory. But right now you're seeing states like Arizona, Nevada, California, and especially Tennessee, where inventory is increasing. Inventory increases are due to the fact of new home construction. So these homes are finished, but no one's there to buy it. And these builders need to sell these homes. So these homes are usually the first homes that you get to see price reductions on. Because someone who already owns a home may not have that much incentive to reduce their prices a lot or so quickly compared to the people who just built homes that need to be sold in order for them to make money. Let's backtrack to the fixed rates. So this is different from commercial real estate, where most of them use adjustable rate mortgages. Over the last week or so, you may have seen a lot of big time players in the commercial real estate industry default on their loans, because as these interest rates are increasing, their payments are also increasing. Some of these giants have seen an increase of 300% on their payments compared to last year. Can you imagine that? Think about it. If you were paying $2,000 in rent, you would see that your rent is increasing every single month up to $6,000 after a year. Nobody can plan for that, and that's why we're seeing defaults. And as interest rates continue to increase, you will continue to see a lot more defaults in the commercial real estate space. They are getting obliterated right now. Now, here's the part that nobody's talking about. Now, there's this weird debate about whether or not we're actually in a recession. Now, the people who say we're in a recession, they're just looking back at the definition that we learned in high school, which is 2 consecutive quarters of negative GDP growth, which we have seen. And whereas the people who say we're not in a recession say that it's because the unemployment is still low, and during a recession, unemployment should be high. The jobs reports have been pretty strong. However, little do people know that some of them have been revised down months after being released. For example, Bureau of Labor Statistics said in the second quarter of 2022 were 1 million jobs created. A few months later, the Philly Fed revised that to say that, hey, hold on, you guys were off by a little bit. In fact, you guys were off by 1 million jobs. There were essentially no growth in jobs in the second quarter of 2022. Now, you may not have heard of this, which is why you should subscribe, but this is kind of a big difference. And this is where it all gets interesting. A lot of large corporations and companies carry on debt in the form of loans. And the interest on these loans have an adjustable rate. So as the interest is increasing, their payments are increasing. And now as we see that the rates are increasing again, these payments are getting larger and larger and larger. So how much of this can these businesses really tolerate? This can really be the straw that breaks the camel's back. Corporations may have to make the decision to lay off workers, and that might be the final piece to really cause some real damage to this economy. And I personally think that if the Fed were to continue to increase rates as they said they would, we can see layoffs start to happen. A good recent example of this would be in California, where there has been tens of thousands of layoffs in big tech. Now look at those cities. Tell me, what do you see in those housing markets? The prices are down, inventory is increasing. Now there's a lot of other factors contributing to that, but I think it gives you a good sense of what could happen if the unemployment starts to go up in different regions of the United States. So I'll leave it at that. If you enjoyed this video, learned something, or want to just keep up with market news, make sure you do hit the subscribe button, and also make sure you hit the like button for the algorithm gods. My name is Joe Majorana, and I will see you on the next one.